Bringing you the latest in tax credit news, this is Tax Credit Tuesday with your host, Michael Novogradac.
Hello, I'm Michael Novogradac, and this is Tax Credit Tuesday. This is the April 18th, 2023 podcast. Happy Tax Day. In this week's episode, we're going to talk about a hot topic. That's a particularly hot topic given the high inflation and high interest rate environment that we're in today. We're going to highlight a couple of financing options that help multifamily residential real estate developers borrow more money at lower interest rates and longer amortization terms. That's as compared to most conventional loans. We at Novogradac have been getting a growing number of calls from real estate developers with respect to two particular HUD loan programs. These are HUD loan programs that offer lower interest rates and longer amortization periods. The two programs are referred to as the Section 221D4 program and the Section 223F program. By way of example, from 2020 to 2022, HUD has closed several hundred more HUD loans under these two programs. From 2019 to 2020, these programs saw a spike of 60%. And then from 2020 to 2021, they saw another spike of 29%. And then 2022 did see a slight dip, but was still about 35% higher than the number of loans in 2019. We'll discuss a little bit more of the numerical numbers in terms of usage of these programs during the course of the podcast. The key point is there's been a large increase in the number of loans closed under these programs. And I think the 2022 dip was largely a function of higher construction costs, financing gaps developing, and developers had to find ways to close those financing gaps beyond the use of these two programs. So of course, the question becomes, why the sudden interest in these two loan programs? And the key question is, or the key observation is that when interest rates are low, as has been in recent years, going back, a year and a half or so, the benefits of loans with lower interest rates and long amortization periods are not nearly as substantial as when the rates are higher. Or maybe said differently, when a conventional loan has a rate that's fairly close to a HUD Insured loan, then the benefits of pursuing the HUD Insured loans aren't quite as great. And some of the challenges of HUD Insured loans outweigh the relative benefits. However, in the current high interest rate environment, HUD Insured loans, in most namely the 221D4 and 223F that we're talking about today, are particularly attractive to help multifamily real estate developers make deals more financially feasible. And by way of example, talking about interest rates, and these rates fluctuate, but as of early April, the interest rate at HUD Insured loans was in the rough range of 5.2% to 6%, while many conventional mortgages we were saying were around 6.75% plus or minus. As I mentioned, these fluctuate. These rates are highly correlated to the 10 and 30-year treasury, which have been volatile over the last year plus, but more recently, the range of the 10 and 30-year treasury has been in the 3.25% to 4% range. Now, the interest rate differences that I mentioned between conventional and HUD Insured may not sound like a huge gap, but even a small gap in that interest rate does lead to significantly more loan proceeds when you're borrowing on a HUD Insured mortgage versus conventional mortgages. And these additional loan proceeds obviously help close financing gaps. That said, before developers do choose to pursue a 221D4 or 223F loan, there are some important differences relative to conventional loans that borrowers should be aware of, which is the purpose of today's podcast. We're going to compare and contrast the benefits and requirements of 221D4 and 223F loans with conventional loans. To do that, joining me today is Tiffany French, a partner in Novogradac's Austin, Texas office, and this is her first appearance on the podcast. Tiffany has extensive experience in loan closing tax credit, tax and bond finance transactions. She's an expert in HUD Insured mortgages, which is why we have her on the podcast today. While this may be her first appearance on the podcast, you may recognize her from her appearance at Novogradac conferences. We have a lot to cover today. So if you're ready, let's get started. So Tiffany, welcome to Tax Credit Tuesday.
Thanks, Mike. It's good to be here today.
I welcome you to your inaugural podcast. So let's start, at the beginning. Always a good place to start, the beginning. I'd like for you to go over each of the loan programs for listeners who are not familiar with them. And maybe you could start with the 221D4. So if you could briefly summarize how 221D4 loans are used, and or more specifically, what types of developments or projects are eligible for 221D4 loans.
Absolutely. So first I want to start off so we don't lose anybody is I often get the question, aren't these programs only associated with affordable housing? So the answer to that is no. And people are quite surprised with that answer. So with that being said, though, there are several things for borrowers to understand with these HUD programs before making the decision to pursue a HUD insured loan. And hopefully we can clear those up today. So first, looking at the 221D4 program, we need to talk about what types of properties are eligible under this program. So eligible properties include multifamily apartment rental projects with 5 or more units where at least 50% of the residential buildings contain 4 or more units. And then detached single family subdivision rentals are not eligible under this program. The D4 program is for a for-profit entity. There is a 221D3 similar program that any nonprofit entities would fall under. These are for single asset entities whose sole asset represents the project under financing. So I've had several clients that have had to actually undergo a restructuring to account for this requirement. So that is something that the borrower should keep in mind when looking at these financing. And once it's determined the project meets these eligibility requirements, then we need to look at what the loan will actually be used for. So there's restrictions on which loans you would fall in as the borrower. So for the 221D4 loan program, it provides financing for new construction or substantial rehabilitation of multifamily apartment developments. And in order to qualify under the substantial rehab, of course, HUD has definitions. So the scope of repairs for that would need to exceed $15,000 per unit, and or 2 or more major building systems would need to be replaced. And HUD defines those as either structural framing, the building envelope, mechanical, electrical, and plumbing. So depending on that type of rehabilitation or major building systems that would need to be repaired. Okay, so after determining whether the project will qualify, a borrower should then consider the key characteristics of this program. So one of the benefits of using a 221D4 loan for construction or rehab is that the borrower can obtain a construction loan which converts to a fully amortizing permanent loan upon construction completion. So what this does, it allows the borrower to obtain a construction loan for a 3-year period with interest-only payments being required at that time. And then the permanent financing piece could be amortized up to a 40-year term. So this can decrease the burden on a developer from having to look for a construction loan and then also looking for a separate permanent loan lender, which is kind of typical with conventional loans. This loan also has a low fixed interest rate for the term of the loan. So that's a really important piece is the fixed. There is a rate lock fee associated with locking the interest rate, but the interest rates, as Mike mentioned earlier, on these types of loans tend to be slightly lower than the conventional loans. The loan is also fully assumable, meaning should a developer sell the property encumbered by a HUD insured loan, the buyer can take on the debt and benefit from all the same items I've just talked about. These loans are also non-recourse to the borrower, and depending on which classification the borrower falls into will depend on the loan sizing and debt service coverage requirements. So HUD has three categories for this, and they all either fall into market rate, affordable, or subsidized. So what is affordable? Affordable in HUD's definition is properties having at least 40% of units at 60% area median income or 20% AMI units at 50% or 20% units at 50%. And then they define subsidized as properties having greater than 90% of units subject to low income housing tax credit restrictions or project based rental assistance under the Section 8 program. And I do see many of my clients that have LIHTC associated with their projects also layering the 221D4 loan with their project with great success and continuing using this program. And
So,
then,
I wasn't sure if you were done there, but go ahead and continue, please.
okay. Yeah. So I just wanted to quickly talk about the loan parameters. So for loans below 75 million for a market rate project, your loan to cost ratio is at 85% with a debt service coverage ratio of 1.176. For a project classified as affordable, the loan to cost ratio is 87 with a DSC of 1.15. And for a project classified as subsidized, the loan to cost ratio can be at 90% with a DSC of 1.11. So these are some of the more favorable loan sizing parameters that are out there. And based on these favorable loan terms for affordable housing under these types of HUD programs, some developers might reconsider adding at least some affordable housing units in the mix. Therefore, by adding affordable housing in the project, they can access the more favorable loan sizing parameters for those two areas. And one last thing on this piece is the minimum loan amount is $4 million. Of course, there are some exceptions, and typically the loans for this program range around 15 million and above. And there's no maximum as long as it falls in the loan parameters we just talked about.
Great. Thank you for that. And sorry for the interruption earlier.
No problem.
That was a great overview of the 221D4. And as you mentioned, there's also the 221D3 for nonprofits, but we won't be discussing that because the main focus of this podcast is for financing of tax credit developments, and the 221D3F and the 221D4 can be used for tax credit developments. Can't use the 221D3 because the property has to be owned by a nonprofit. So you gave the overview of the 221D4. Could you provide a similar overview for 223F? Let me rephrase that. I know you can. Please. My mom would be saying, of course you can. So please share a similar overview for 223F.
Sure. So looking at 223F, starting about eligible properties, it's pretty much in line with the D4. So projects with 5 or more units and at least 50% of the residential buildings containing 4 or more units. Also in this program, the detached single family subdivision rentals are not eligible for this type of loan. I have a couple of clients who are trying to develop these types of projects, so this wouldn't fall for them. And just like the 221D4, the majority of the projects being financed under this program have been unrestricted market rate projects. So again, the answer to the affordability question, no, you don't have to be affordable for this project or program as well. Now looking at some of the differences from the D4 is the 223F loan program provides financing for borrowers who are looking at acquiring, refinancing, and or key term moderate rehab. So the 221D4 was for substantial rehab. This one is for moderate. And the definition for moderate is pretty much the opposite of substantial. But if there's any proposals for repairs for rehabilitation under the 223F, it can't exceed 15,000 per unit, and it can't have 2 or more major building systems replaced. So complete opposite. If your project falls into that, then you want to be looking at the 221D4 program. So the key characteristics of the 223F include an amortization period up to 35 years with a minimum of 10. And so this is, again, a little longer than your conventional loan, which is typically about a 30-year amortization period. The loan is fully amortizing and also includes a low fixed interest rate for the term of the loan. And similar to the D4 program, there are the same three categories for the loan sizing parameters. It's the market rate, affordable, and subsidized, same definitions. So for the market rate projects, the loan to cost ratio is at 85% and a minimum debt service is at 1.176. For affordable, the loan to cost is 87% and the debt service coverage is at 1.15. And then for our last category, subsidized, the loan to cost is 90% with the DSC at 1.11. There is a cash out option for this loan program, but those loans are limited to 80% of the loan to cost ratio. And then lastly, the minimum loan amount for this HUD program is $1 million. So,
Great. Thank you for that. And so now we've had an overview of 221D4 and 223F. And in my introduction, I did talk about the rise in interest in these two HUD insured loan programs over the last few years. And I went through a variety of sort of years and percentages. It might be useful for our listeners if they had some specific numbers. So if you could please share for our listeners the specific numbers in terms of HUD insured loan closings in 2018 through 2022, so they have a sense of the arc of the number of loans.
absolutely. So, over the last several years, I received an increase in the number of calls for consulting and new review engagements for these two types of loan programs. My clients who have LIHTC have, since I started with Novogradac, have always used this type of financing. So I was curious as to why new developers were coming into and looking at these two types of programs. So looking in through the years at the closings that have happened. So, I started back in 2018 and there was 889 new transactions. And it stayed about the same for 2019. In 2019, there was 876 new transactions that closed. And then it really changed from there. And in 2020, there was 1,407 closings. And in 2021, there was 1,812. So that's a pretty big increase to me, which makes sense why I would see an increase in new developers.
And then in 2022, as I mentioned in the intro, there was a dip. And I think the numbers were 1,181 or just under 1,200 closings in 2022, which is obviously down notably from 2021, where it was at 1,800 or over 1,800. And I suspect that the reason of that decline is with rising construction costs and the rest. Many developers had to find other ways to close the financing gap, or they were delaying their closings to see if construction costs might fall a bit before, closing the loan. But in terms of the spike between 2019 to 2020, there was an increase of 61%. I was wondering what you think were some of the chief causes of that sudden increase, if there was anything beyond sort of higher interest rates and or the benefit of longer amortization terms.
Right. So I would think there's a number of different factors that led to that. And each development has different needs, but some factors that would attract a developer to one of these types of loan programs over a conventional would be the ability to obtain the higher loan to value ratio and longer fully amortizing loan. But another contributing factor, what I would think would be in 2019, FHA expanded a pilot program. So there was a pilot program that was out and about for the 223F program. And this was for applications. And in 2019, they changed it to include the 221D4 program. And what this pilot program did, it ensures faster and more efficient processing for LIHTC transactions by eliminating some of the internal reviews that were required. So this would be why my developer clients in the LIHTC arena um, maybe were more interested in HUD financing at this time, because one of the downfalls of these programs is the processing time. It does take longer for that. And so allowing for a shorter application review for borrowers to lock in those better interest rates sooner, which would definitely be important in this rising interest rate environment. So I would think that would be one of the things that might have changed that.
Yeah, it makes total sense. So we've talked about the benefits of 221D4 and 223F, namely lower interest rate, as well as longer amortization terms. And by having a lower interest rate, longer amortization terms, a good amount of cash flow, all other things being equal, you can generate more loan proceeds to help close the financing gap. Are there other benefits to 221D4, 223F beyond those two that you think developers should be particularly aware of?
You know, one of the thing I was going to mention is, a lot of market rate developers didn't even consider a HUD loan program for the sheer fact that there is this misconception that it is for affordable housing, but it's not. It's for everybody, market rate, affordable, subsidized. There are, like I talked about, more favorable terms for affordable and subsidized, but it's still possibly a better option for a market rate developer as well. And just the longer amortization period, you can take out a higher amount of loan. So your loan to cost value is higher. So you can take out more loan proceeds and pay those over a longer period of time. And with the slightly lower interest rates that we've been talking about, you can get more money with equivalent payments as you would a conventional loan.
Great. Thank you for that. And I would just note that to the listeners that there's, a variety of other kind of factors in terms of determining the maximum loan amount, that it would include differences between conventional and HUD insured in terms of the types of underwriting that are done, in terms of estimating rents, estimating operating expenses, minimum replacement reserves, debt service coverage ratios, and all the like. So, that's one of the reasons why you want to work with whoever you're dealing with in terms of identifying what type of loan you're going to have them run different numbers so they can give estimates that go beyond the interest rate and amortization term into some of the other underwriting differences that can be meaningful in terms of loan proceeds. And obviously, we're very focused on the loan proceeds amount as opposed to having a quote lower payment, because from a real estate development perspective, you're looking at closing financing gaps, and more loan proceeds allows you to, work towards closing any financing gaps that you have. So we've talked about all these wonderful benefits. So listeners are going, well, great. I had to just go down the HUD insured route. But there are some challenges.
Yes.
Using insured loans, particularly when you're also applying for loan closing tax credits. So maybe you could discuss some of the general challenges of HUD insured loans with an eye towards marrying HUD insured loans with a loan closing tax credit development.
Sure. So, just as many as there are benefits, there are challenges, like you said. And I mentioned one of the biggest being the timing. So for a 221D4, timing can be as long as 9 to 12 months from engagement to closing. So, and it's important for the borrower to understand the application process for these HUD programs. So for a D4, it's a little longer. It involves a concept meeting, pre-application, firm application, and then closing. And there's a lot that goes into each of these stages. And then for the 223F, the typical closing is anywhere from 5 to 7 months. So, and it's a little less involved. So there's only a concept meeting, HUD application, and closing. And I say only, there's a lot involved in each of those, but it is a little shorter in time frame. Um, and of course, the timing varies depending on the complexity of the transaction, the cooperation of the borrower. There are HUD restraints at the HUD level. So depending on the number of application HUD is receiving at that point in time could hold up the closing. So these are all challenges for a borrower to keep in mind when they are looking at this. And then in marrying the LIHTC program with it, we talked about the pilot program came out in 2019, which implemented a decrease in the processing time. So this would definitely help with the LIHTC timeframe that you have to work in. It also, like, one of the things I do see with this is that, like you were mentioning, Mike, about closing the gap. And for 4% bond LIHTC transactions, I do see the D4 program working quite well with that. Again, you have the higher loan to cost value ratio, so you're able to take out more proceeds and help fill that gap. So they have worked with this program very successfully on 4% bond deals, but they also do on 9% as well. It's a good marriage, I guess, between the
Yes.
two. And in addition to timeframes, we're talking about HUD programs, and there is going to be extensive paperwork. And if you've worked with LIHTC projects, you know the paperwork that goes into that. This just adds on top of that. And so this can be daunting and might be something that would prevent a developer from pursuing just all the extra work that has to go in with a HUD program and the applications.
So you talk about that in terms of the, you know, more paperwork with respect to the application, which generally is a response to the HUD loans having more requirements. There's more upfront requirements and more annual or periodic requirements. So beyond the application phase in of itself, taking longer and having, additional or more expansive submission requirements, what are other upfront requirements and annual or periodic requirements that might be different than a conventional loan?
Absolutely. And there are quite a few. So, some of the upfront requirements, there's additional fees involved with the HUD loan program. So, additional lender financing fees, application fees, HUD inspection fees that they add on to that. HUD also requires the FHA lender to collect an operating deficit escrow on new construction and substantial rehab applications. And this provides funding for operating expenses and debt service when there's not sufficient cash flow available during the initial lease up period following the construction. HUD mortgage also requires mortgage insurance premium fees upfront, and this is charged for providing a credit enhancement in the form of the FHA mortgage insurance, which provides access to the favorable interest rate terms available under these HUD loan programs. There is an initial deposit and there's a monthly deposit required after closing. Um, Another reserve that's required is the replacement reserve. There's, again, initial deposit on this one, and monthly payments are required therefore. In addition to that, there's scrutiny for this reserve. So throughout the life of the loan, there's only certain things that you can ask for the replacement reserve withdrawals from, and they have to be HUD approved. And there's various third-party reports required to be considered during the construction phase. And then if you are looking at a 221D4 for construction, that adds some more requirements on top of that. And when there is an identity of interest contractor involved, HUD requires the contractor to undergo a contractor's cost certification, and that's performed by a CPA, and then a mortgager's cost certification on the mortgager's side. So those are in addition. If you have tax credits involved in your project and you are looking at a 221D4, back in 2008 with HERA, they changed the borrower's obligation, where if there's tax credits, and those tax credits can be LIHTC, historic, or new market tax credits, and the project is less than or equal to 80%, the borrower's not required to certify actual cost. So this is more of HUD helping when there's tax credits involved to get those projects applications closed. And then because FHA has insured the construction debts and those counts as federal program under the D4, the contractor would also be subject to Davis-Bacon Act. And this just ensures the contractors are paid at a minimum prevailing wage for that area. And during application there's also a requirement typically for a CPA to perform a review of the financial statements. And over the past couple of years, this has kind of thrown my new developers. They might not have been prepared for that. So just be aware that there is going to be some engagements required during that pre-application and application, which can be time consuming. So that goes back to the time frames. And then kind of looking at after closing, one of the biggest things that I see that distinguish it is, most lenders require audits. But when you have a HUD program, you're subject to a HUD audit now. And so some of the things that we would look at during that time is we test the replacement reserve deposits. We make sure that the monthly payments are being made in accordance with your regulatory agreement. We make sure any withdrawals through the life of the loan has been HUD approved. There's also surplus cash limitations. And this also throws a lot of people. And this is where I kind of spend a lot of upfront consulting time, just getting the developer familiar with what surplus cash means in accordance with HUD and what is allowed to be paid from that. There's also HUD has to approve the management agent. So they'll issue a management agent certification. And that's one of the things we look at during the audit is to make sure that's HUD approved and the management agent is being paid in accordance with that. And then, of course, we also look at ensuring the project's properly insured during the year. And so there's certain requirements on insurance limits, fidelity bonds, and so forth that they would have to abide by. Some other things outside of what we would do in our audit is the project would have to undergo a management occupancy review. It's performed at HUD's direction, and it's at various times throughout the life of the project. HUD also requires REAC inspections of the property. And with that, there's typically additional cost to the borrower to ensure that the project passes that REAC inspection. And if they don't, then there could be repercussions from that. And one thing I did want to talk about in the surplus cash limitation, and this kind of changed at the end of 2022 in September. Previously, all regulatory agreements you were only allowed to make distributions semi-annually. So at mid-year and end of year. And that was only with the assumption that there was surplus cash. So a surplus cash calculation would have to be made. And then depending on if there was, distributions could be made at that point in time. After September of 2022, they have changed the new regulatory agreements going out after that date to monthly distributions. So this might be something that helps favor these HUD loan programs because it's not just semi-annually anymore, it's monthly. So that would be something to think about as well. And I think that's really the bulk of some of the major differences and where I see a lot of my consulting time working with new developers with these programs.
Well, thank you for that. That was pretty thorough. I'm sure the listeners appreciate that. So some listeners are now saying, okay, I want to learn more about whether or not a D4 or 223F loan is right for me. What do you think the next step should be for those listeners?
So getting a good team involved as early as possible to help with the process. So they would want to reach out to one of the HUD approved lenders, and that's listed on HUD's website. You can find HUD approved lenders there. That's going to get the ball rolling. You'll want to make sure and have an experienced lawyer who is familiar with the HUD program and all the vast documentation and agreements that you'll be entering into. And of course, hiring a CPA firm that is familiar with the HUD program. I like to get involved pre-application. At any point in time, I'm happy to get involved, but typically that's the easiest. And I spend a lot of time up front working through these programs, and having a good HUD consultant with you would help you be able to navigate and understand the different programs that are out there and available for you.
And I'll be a little bit more direct to our listeners. You were quite gracious. I would suggest that the listeners give you a call
Absolutely.
or email you, and we'll put your email in the show notes today. And if you're interested in pursuing, reach out to Tiffany. She can give you a list of HUD insured lenders that you could then reach out to. And she could also share 3 or 4 or 5 names of attorneys with
Yeah.
experience with these loans. And you can you can end up talking to the various lawyers as well as the lenders and decide which ones would work best with you. I know Tiffany can fill the role of the
I absolutely can. Love to.
So thank you, Tiffany. There's obviously much more we could discuss about 221D4 and 223F, but we can't fit it all into a single podcast. So as I mentioned, we'll have your contact information in the show notes. So please reach out to Tiffany if you have any questions. And Tiffany, do stick around for our off mic section of the episode where I get to ask you some fun off topic questions to get your recommendations and words of advice.
Okay.
And
Sounds
to our
good.
listeners, be sure to tune into next week's episode, which will be a must listen for any local housing tax credit property owners or those who are seeking to acquire a local housing tax credit property, which is a pretty expansive list of potential listeners next week. The reason why it's so expansive is we're going to discuss year 30. And you've likely heard of year 15, which is the end of the tax credit compliance period and how to reposition properties and the like at the end of that tax credit compliance period. You may not be as familiar with year 30. And year 30 refers to the end of the local housing tax credit development's minimum extended use period. As you may know, under federal law, generally, all local housing tax credit developments with credit allocations after 1989 must maintain affordability for at least 30 years. And I'd say at least because that's the federal requirement. State allocating agencies can extend the affordability requirement even longer. For example, California has a 55-year extended use period. And I do say generally, you have to maintain affordability for at least 30 years. And that's because there is a qualified contract option at the end of year 15 that many states allow developers to avail themselves of, and it is part of federal law, but many states do not allow developers to avail or owners to avail themselves of the qualified contract, California being one of those. And one of the reasons why we're talking about year 30 now is, as hard as it is to believe, 90 was 33 years ago, which means many local housing tax credit properties today have reached or are approaching the end of their extended use period. Next week, my partner Chris Key and I will discuss various options available to property owners at the end of an extended use period. So whether your local housing tax credit property is at year 30, and you're looking at buying properties that are at year 30, or even if you're 10 or 20 years out from the end of your extended use period, it's good to know what options you have, what additional options you might have at the end of year 30. And by the way, if you do have any questions that you think we should cover in that episode, please email me at cpas@novoco.com. So now we've reached our off mic section. And I think this is an especially appropriate question now that we've reached tax day. So Tiffany, what's a tip you can share about staying organized?
So organized, it goes simultaneously in the accounting world as anything else. So especially
Yes.
during these first months of the year where we're working on hundreds of engagements all at one time, keeping track of everything is pretty daunting. So I am all about task and list, and that's how I get organized. Without my list, I don't know if I would make it through a day. And I think I've worn off on my team, which I'm happy about because we have lists for everything, I feel like. One of our main list trackers is we use it in Teams. So I was really happy with that function. And we put our list in there and we can be in there at the same time, updating it real time with each other, looking at it. So we start our Mondays off with a call to discuss priorities and look at our list and figure out what each of us needs to do during that week, whether we need to meet again on specific engagements, but we keep track of everything on that. And in my emails, I have a section for task on the side and I coordinate my emails. If I don't respond immediately, whether I'm going to respond today in a task or tomorrow or next week. And I thought this was just the way everybody did it. And I was sharing my screen with my senior and she was so impressed that we had to stop what we were talking about and had to walk her through on how I coordinate that. So I'm definitely wearing off on my team for that. Another thing that I think is really important in staying organized is just communicating. Like I said, we do Monday meetings, but with my senior, it's almost every morning we start off the day with a quick call. Where are we at? What's in our list? Who's asking for what today, tomorrow? So communication is really key and staying organized.
Great. Thank you for that. And certainly communication is super important and something you sometimes don't think about in the context of staying organized. You point out how important it is.
Yeah. We don't communicate. There's no organization there because it doesn't work.
Exactly right. Exactly right. So with the busy season almost behind us, obviously at Novogradac, busy season is never behind us. But my next question is for a recommendation. And I was curious what interesting book, podcast, or TV show you might recommend to me and our listeners.
So I thought about this. And so I listened to a wide range of books on Audible. And one that I have come across, I have 3 children in high school, middle school, and elementary. So I looking at things that would help me navigate for their different needs because they are very different. I came across this book called Raising Good Humans. And I went into it thinking, oh, great, it's going to teach me how to direct my children and what my children should be doing. But I quickly found out it wasn't about that. It was about looking at yourself internally and how you respond and having a mindful attitude when you approach your children or anybody in that matter. And that's what I found really interesting in this is it not only showed me how to react and interact with my children, but just in my everyday life, being mindful of how I approach situations. And the exercises that it has you go through, really listening to what you're saying, listening to what the other person is saying, and not just reacting what you think they're saying. But it's really helped me overall with how I communicate, I feel like, and just keeping a mindful attitude.
Thank you for that. I've not listened to it or read it. I'll add it to my Goodreads want to read list or
Yeah,
list. So thank you again, Tiffany.
absolutely. Thank you for having me.
And to our listeners, I'm Mike Novogradac. Thanks for listening.
This weekly podcast has been brought to you by Novogradac and Company, LLP. Archived podcasts are available online at www.novoco.com/podcast or by subscribing to the Tax Credit Tuesday podcast in iTunes, Spotify, YouTube, Google Podcasts, Stitcher, and Radio Public. You can find related links referenced in this podcast on our website at www.novoco.com/podcast. Novogradac and Company, LLP is a national certified public accounting and consulting firm with offices nationwide. Learn more about our professional services at www.novaco.com.